At the beginning of 2023, there were a lot of fears about global slowdown, including high probability of recession in the US. Despite this backdrop and against the odds, India has been able to clock a GDP growth rate of 7.8% year-on-year for the first quarter of 2024. As per the IMF, India is expected to be the fastest-growing major economy going into this year as well as the next year. India is poised to navigate the prevailing challenging global landscape more effectively, since it is the least indebted nation amongst the major countries. The trajectory of GDP growth and stock market performance can be very different over a short time period. Some of the key reasons are that the financial services sector comprises about 32% of the NSE 500, but only has a 5% representation in the GDP. The agriculture sector comprises 19% of GDP, and has little presence in the top 500 companies. Similarly, real estate and manufacturing sectors have about 16% representation each in India's GDP, but hardly any representation in the top 500 companies. In the last 10 years, India's contribution to the global market cap has more than doubled from 1.6% to 3.4%. Corporate leverage is at a 15-year low. The corporate results for Q1 FY24 were better than expected with a 32% PAT growth year-on-year. Consequently, the FY24 EPS for Nifty has been upgraded by 2.5%. BFSI and auto are expected to drive earnings growth for Nifty 50 in FY24. The current temperature index suggests large cap valuations are at the fair value zone. For incremental investments, we continue to suggest 50% deployment immediately and 50% to be staggered over 3 months while being able to accelerate deployment during sharp corrections. Based on trailing 12 months earnings, temperature gauge index suggests that large cap valuations are still in fair zone. We recommend to adopt a complete staggered approach for select mid and small cap strategies across MF, PMS and AIF platforms. Market expectations are moving towards higher for longer with a pause expected in 2023 for the US Fed funds rate. Although domestic inflation saw a recent spike, the major contributor was food inflation, which is expected to moderate over a period of time. RBI is expected to actively manage system liquidity till inflation reverts back to the target range. The flatness in the yield curve continues with a sweet spot lying between the 3 to 5 year maturity. We suggest that around 65 to 70% of the fixed income portfolio should be allocated equally to 3 to 5 year maturity high-quality GSEC, or AAA equivalent accrual debt funds and equity savings funds. To enhance the yield, 30 to 35% of the overall fixed income portfolio can be allocated to REITs, InvITs, select high-yield NCDs, and private credit strategies. For liquidity management, or temporary parking, investments can be allocated to arbitrage, ultra-short-term, liquid or overnight strategies.